So you've decided to put your retirement funds into an SMSF. That's great. Now, what else do you need to do to manage your SMSF successfully? First, let's look at SMSF eligibility. For a fund to be an SMSF, it must meet several requirements under superannuation law. It must have 4 or fewer members. Each trustee is a member and each member is a trustee. You can use a corporate trustee, but members then need to be directors of the trustee company, and the directors also need to be members. No member can be an employee of another member unless they're related. And no trustee or director of a trustee company can be paid for their duties or services as a trustee of the fund. As an SMSF trustee, you're ultimately responsible for running your own SMSF. You must understand your duties, responsibilities, and your obligations. An SMSF trust deed is a legal document that outlines how the fund will be set up and how it will operate. The trust deed and the SIS legislation guide all decisions made by the trustee in relation to the trust. This document establishes the trustee relationship between the trustee settlor and the beneficiaries, and in this case, the SMSF members. All SMSFs need to pay a supervisory levy and lodge an SMSF annual return. This will report income tax, member contributions, and super regulatory information to the ATO. Your SMSF is required to have its financial statements audited by an independent SMSF auditor on an annual basis. As a trustee, you're required to appoint an auditor to audit your fund each year. You need to do this at least 31 days before the due date of the SMSF annual return. Your auditor must form an opinion as to whether both of the following criteria apply. The financial statements are a fair representation of the financial position of the fund, and the fund has complied with the relevant superannuation law. Now you've created your fund, it's important to ensure your fund's compliance by meeting the sole purpose test. The sole purpose test means that your SMSF is run with the sole purpose to provide benefits to members upon their retirement, or to dependents if a member passes away. Contravening the sole purpose test is very serious and may lead to trustees facing legal action. Members can't receive a benefit from the fund before their retirement. For many people, the main drawcard of an SMSF is to gain greater control over your investments. When preparing and implementing the investment strategy for your fund, you need to ensure it's reviewed regularly to ensure it still meets the members' retirement needs. Here are some points to consider when preparing your strategy. You need to invest in a way that maximises member returns by ensuring you take into account any risks associated with the investment. Consider your asset allocations and the benefits of diversification by investing across several different asset classes. For example, shares, property, and term deposits. Decide if you wish to hold insurance cover on the lives of the members of the fund. And finally, ensure your members' circumstances, things like their age, their income levels, are taken into account so that the SMSF can meet their retirement needs. Remember, it's important to ensure you have a documented investment strategy. When constructing the investment strategy for your SMSF, you need to consider the objectives and obligations of the fund to provide benefits to its members. Part of this is taking into account the risk profile of the members, and a risk profile helps to determine the level of risk within a portfolio that a person is comfortable with. There are 5 main investor risk profiles. The conservative investor tends to focus on income rather than on capital growth. Their investment portfolio is generally biased towards security of capital and providing income over capital growth. Investments typically have a higher liquidity level. A moderate investor, on the other hand, is an investor seeking to protect the wealth they have already accumulated. The majority of their investment portfolio is structured towards income-producing assets rather than assets that offer capital growth. A balanced investor has an investment portfolio that has a dual focus of capital growth along with the need for some income. Growth investors generally have a bias toward capital growth. They're prepared to accept a higher degree of calculated risks in order to achieve better returns. However, they also understand that they need to receive some income in order to reduce the downside risk to their capital. A high growth investor is prepared to take higher risk for potentially greater returns. Overall, they have a greater need for capital growth than for income. They're well placed to recover from unforeseen market downturns, either because they have time on their side or access to capital reserves. The risk profile of you and your other members may be different and will likely change at different stages of your life. Factors that can influence this include their investment experience, contribution amount, and life stages of each of the fund's members. It's not uncommon for some members to be in accumulation phase, whilst others are in pension phase. This information will play a large part in guiding the SMSF's investment strategy. There are so many strategic and compliance matters to think about in order to manage your super successfully. Here at Alton, our specialist team administers over 240 self-managed super funds. Our wealth management team specialises in providing investment and strategic advice, making us the ideal partner for all of your retirement planning needs.